turning $10,000 into $300,000 sounds impossible, right? But what if I told you this is exactly how ordinary investors quietly build wealth every single year, without winning the lottery, without becoming influencers, and without gambling on risky trades? Because the truth is, most millionaires are not created overnight. They're created through consistency, patience, and compound growth. And in this video, I'm going to show you exactly how a simple $10,000 investment can realistically grow into over $300,000. Most people save money, but inflation slowly destroys its value. Meanwhile, investors make their money work for them. Money behaves differently when it's invested, compared to when it's just sitting in a bank account. And the biggest weapon investors use is compound interest. Now, don't panic looking at the formula, because the idea is actually simple. You invest money, it earns returns, and then those returns start earning returns too. It's basically a snowball effect for wealth. For example, if you invested $10,000 into the stock market and earned around 10% annually, which is historically close to what the S&P 500 has averaged over long periods, your money would keep growing year after year. But here's where people make a huge mistake. They think investing is about getting rich quickly. So they chase hype, panic buy, panic sell, and eventually lose money. Real investors think differently. They focus on long-term growth because the market rewards patience, not emotion. Now let's break down the actual numbers. Imagine this scenario. You start with $10,000. Then, every month, you continue investing just $300 consistently. Instead of spending that money on random things, you invest it month after month, year after year. Now watch this carefully. After 5 years, your portfolio could grow to around $40,000 or more. After 10 years, it could cross $90,000. After 15 years, you could approach $180,000. And after around 20 years, your investments could realistically cross $300,000. Not because you got lucky, but because compound growth became stronger over time. This is the part most people underestimate. The first few years feel slow. Sometimes it even feels pointless. But eventually, growth becomes exponential. Your money starts growing faster than your contributions. That's when investing becomes powerful. And this is why starting early matters so much. Because time is more valuable than the amount you invest. A person who starts investing at 20 with smaller amounts often beats someone who starts later with way more money. So, what should you actually invest in? Most successful long-term investors keep things simple. They focus on index funds, ETFs, and strong companies that dominate the economy. Companies like Apple, Microsoft, and Nvidia. Instead of trying to predict the next big thing, they buy quality assets and hold them for years. Because boring investing usually wins. Now, obviously, investing is never risk-free. Markets crash sometimes. Recessions happen. Fear spreads everywhere. And during those moments, most people quit. But historically, the market has always recovered over long periods. That's why experienced investors stay calm during panic, because they understand that downturns are temporary. But long-term growth is powerful. You do not need to be rich to start investing. You become rich by investing consistently. So, if you take anything away from this video, let it be this. Your first investment matters more than your perfect investment. Start early, Stay consistent and let compound interest do the heavy lifting. Subscribe for more finance content, and I'll see you in the next one.